the negatives are in the ascendancy. They dominate at the moment. Most of what you're reading in the newspapers is going to be negative around people talking of there's a recession coming along. I'm not sure people necessarily know what a recession means these days. I certainly don't expect it to be anything remotely like the 3% shrinkage in our economy during the 2008-09 period, or stuff we experienced in the 1970s, 1980s. But the talk of it is enough to get people concerned about where things are heading. Well, hello everybody. Welcome to this pre-Christmas special, the final video for the year for New Zealand Home Loans and myself. Obviously, the format is a little bit different this time around. I'm just going to be talking directly to yourselves and asking myself some questions, and fairly much starting with what has happened this year, 2022, in the residential housing market, interest rates, etc. In New Zealand. Because fairly clearly, we've been through a very interesting period for the New Zealand housing market over the past few years. House prices rising strongly over an extended period of time. Pandemic comes along in 2020. We figure house prices are going to fall. They only go down by 3%, and then they rocket upward by about 45% or so, and then far stronger than expected price declines since the peak in November last year. So I want to get right in front here, a bit of a disclaimer. If you think you hear me give a number on my expectation for interest rates, house price changes, unemployment rate, economic growth rate, don't fixate on that number, because basically everybody's forecasts around the planet have been wrong for an extended period of time. So this is an environment where you have to be relatively nimble if you're doing things relatively frequently there, and other times you need to stand well back from the market to try and see things more clearly. And then the greatest insight you might get would be when you see something just unrealistically high or unrealistically low. And of course, I guess that's what I was pointing out late in 2020 and the first half of 2021, when the 5-year fixed mortgage rate was at 2.99%. And I said, that's good enough for me. This ridiculous environment we're in is probably not going to be repeated. And of course, I've had a few people email me and say they're happy to have signed up back then, but most people are on the short-term interest rate, so we'll have a wee bit of a look at that later on and see what people are going to roll on to. Okay, so let's just start with what has really happened over 2022, and let's just start with prices, and maybe it's easier to look at the price changes from the peak of November last year. On average, New Zealand house prices are down about 12.5%. Auckland and Wellington are down by about 17 and 18%. Canterbury down about 5% or so in price. For Auckland, that extra weakness I think we can put down to population shrinkage in our biggest city of 1.1% over the past 2 years, because the rule of thumb for New Zealand is that when we Kiwis leave the country to go overseas, we leave everywhere in New Zealand, but when people come into New Zealand, they have a high tendency to go into Auckland. That's what the migration flows in and out of the country do, and obviously with the borders closed, that was an extra source of weakness for Auckland. Wellington, the extra weakness there I think was simply because it became well overpriced. I was pointing out on a number of my graphs there how prices were very high and beyond the pale in Wellington, so maybe not surprising we've seen a strong correction there. And for Canterbury, of course, we've still got a bit of a catch-up post-earthquake. That catch-up in prices started in the June quarter of 2021, and there's a bit more left, not a huge amount, but still a bit more left there, which says to me whatever's happening for the next year, Canterbury is likely to do a bit better than most other regions. In fact, possibly all other regions around the country. Sales of dwellings relevant to the real estate agents, they peaked at 100,000 in the year to June 2021. And now we're down to about 87,000 and falling away. We're going to go maybe 60, 65,000 or so sales there, so reduced turnover. FOMO, fear of missing out. I've got the only reading of that in the country, and October or so last year, I had 70% of real estate agents in my monthly survey saying that they could see buyers worried about prices escaping on them. Well, since early this year, February or March, that's been basically 5% and going nowhere at all. So I think it's fair to say there is no FOMO any longer. There is instead FOOP. fear of overpaying. Only 19% of real estate agents late last year said they could see buyers worried that they might buy and prices would fall. Now that's been 70% of agents observing that for a period of time. One final thing maybe worth noting of developments in housing in 2022, the number of consents issued for new houses to be built, that has only just started to fall. You'll be seeing the media discussion about building companies falling over. You're going to see a lot more. It's just like the house prices went well beyond the pale in the second half of 2021. I think the same thing has happened in residential construction. And I started warning about this in the first half of 2021 that the sector was going to go through a correction. That I think is going to be possibly the dominant housing overall story for 2023. Now, why have we had prices falling so strongly since late last year? A number of things coming together all at once. Obviously, a key important factor has been the increase in interest rates. If we go back to the early part of this year, we had the likes of the 3.5% 1 year fixed mortgage rate. We got ourselves to 5% towards the middle of the year, and of course 6.5% now. People rolling off low rates into something higher, but it is just the high interest rates out there. A bit of a surprise to the younger buyers who've only known the period of low interest rates, falling inflation over the past almost decade or so up until recently. So interest rates going up, definitely a cause of restraint. But the key things would be the changes in November last year to the loan to value ratios, the LVRs. The percentage of lending banks could do with small deposits was halved in November last year. And then the Credit Contracts and Consumer Finance Act changes effective from December 1 last year meant banks just pulled back aggressively like we haven't seen maybe since a brief period in the global financial crisis. And those were basically the two straws which broke the back of the housing market. People stood back, looked at the high prices, limited access to credit, rising interest rates, and things have fallen away obviously to a tremendous degree. So that's what I would cite as the main reasons we've seen the prices falling away so strongly. What was happening there very late last year. If we have a look now at, I guess, most recently, the data and some of the things that have been happening now, we have to ask ourselves, is this decline going to continue through this last part of 2022 into the early part of 2023? And especially in the context of, if we go back to about July this year, I spoke about the housing market downturn has entered its end game. And I had to stress fairly strongly for a while there, I wasn't saying house prices were going to rise. I was saying that the speed with which house prices would be going down was going to diminish. And we saw that play out over the likes of June and July. In fact, for the 2 months before then as well, so about 4 months overall, house prices on average in New Zealand fell about 2% a month. And then we had 2 months in a row of minus 1.3%, minus 1.3%, minus 0.7% in October. And then in November, prices actually rose by 0.2%. I'm going to call that an outlier. I think prices really underneath have still been going down. And why do I say the end game under play, as in prices falling, but at a slowing rate? Well, things like the fact that prices had already fallen a long way, and that was improving affordability for more people as each month was to go by. Also, job security being very high. New Zealand's unemployment rate has been 3.3% all this year, so that's something different in supporting the market. Also, strong wages growth in the year to September. Average hourly earnings in the private sector have gone up by about 8.6%. That's not just wage rates up. That average increase looks maybe around about 5.5%, but people have shifted jobs. They've gone to higher paying jobs. So it's an interesting dynamic. Prices falling and yet income going up. It's improved the affordability for some people, at least meeting some of the criteria for the banks offsetting some of the obvious negative impact from the interest rates going up there. Also, we've seen the eligibility for Kāinga Ora Homes and Communities Government Housing Department there improving for access to finance and grants for first home buyers. So that's definitely had an impact on first home buyers coming into the market. And then also banks have been improving their willingness to lend, getting used to the CCCFA regulations there. So nothing major, but definitely a slight increase in their willingness to lend since the real credit crunch, which was from November last year through to about March or so this year. Now, this is where it gets interesting. I've referred specifically to late last year, the LVR change and the CCCFA change as key causes of housing market falling away strongly. Well, we've actually had two other really big changes over the past 2 months in New Zealand. And we have to ask ourselves, do these changes mean we're in for a new really strong period of price decline? And what I'm referring to there would be October 18. We got the annual inflation number out in New Zealand. We thought maybe it was going to go from 7.3% down to 6.6%. Instead, inflation was much higher than expected at 7.2%. And we saw the wholesale interest rates, the cost to banks of borrowing money, go up. We saw fixed mortgage rates go up by about 0.5%. And then, of course, we have the November 23 monetary policy change from the Reserve Bank. They increased the official cash rate by a record 0.75%. They increased their prediction for the peak in the cash rate from 4.1% to 5.5%. And they did something which, in my opinion, they really should have been doing much earlier in 2022, and that was scaring the bejeebers out of you and I with talk about recession, rising unemployment. That's the second weapon that a central bank has at its disposal when it's looking to tighten monetary policy: raise interest rates, scare people, so people will go, yeah, nah, I'm a bit worried about what they said there, I'm going to pull back on my spending. And ultimately, when a central bank is raising interest rates, that's what they're looking to do: get consumers to pull back on their spending. So we've got to ask ourselves, with these two sort of things that have happened over October and November, does this mean that 2023 is going to be a repeat of 2022? So let's have a look at some of those things that are going to be influencing the market over the coming year. Now, I think the first thing to say is that the negatives are in the ascendancy. They dominate at the moment. Most of what you're reading in the newspapers is going to be negative, around people talking of there's a recession coming along. I'm not sure people necessarily know what a recession means these days. I certainly don't expect it to be anything remotely like the 3% shrinkage in our economy during the 2008-09 period, or stuff we experienced in the 1970s, 1980s. But the talk of it is enough to get people concerned about where things are heading. The Reserve Bank's prediction of the unemployment rate going from 3.3% up to 5.7% also got people concerned out there. We have, of course, the extra most recent 0.5% increase again in interest rates from the banks out there. So the fixed mortgage rates have gone up basically 1% over the past month and a half or so. And we've got these reports about building companies collapsing. That's hardly a positive for overall sentiment in the building sector. But the question is this: do I think the negatives we see around us at the moment are going to continue through all of 2023? And my response there would be, no, I do not. I still believe we are in the end game for the period of the falling house prices. But if we go back to the early part of 2021, it was about in March or April that year when I said we're in the end game for prices going through the roof. But they didn't peak out until November. So what is that, sort of 8 or 7 or so months from when I was saying it to when the market peaked out? Well, maybe we're looking at a similar period of time for the market, going down. And reasons why I think we're still in the end game is what I'm going to run through now. And this is some of the material that I've been putting out in my general writings recently as well. So in no particular order of importance, let's just start with population growth. New Zealand's population in the year to June 2022 grew only 0.4% after growing 0.6% in the year before that. On average, in the past quarter of a century, growth has been about 1.2% each year in New Zealand, so below average population growth. Yet what we can see happening out there now is that the net migration numbers, they're turning around more quickly than any of us were actually thinking on the positive side, in that we've got a net migration loss in the year to about October of 8,000 people. We definitely have Kiwis going overseas, predominantly, of course, to Australia, where I'm sitting right at the moment. But there's a good number of people coming in from the rest of the world. I certainly don't think it's enough in terms of what employers are looking for, and I don't believe they necessarily have the skills, etc., that employers are looking for. But what the heck? That's still extra people going to be sloshing around the economy. So I think that population dynamic is going to start to be more supportive as each month goes by in 2023. It's not a hit bang sudden sort of a thing, but it's just a little bit of extra support coming along underneath. And another factor in play is sort of similar to that, and that's one I've already mentioned there, of incomes going up. In New Zealand, we're actually seeing a response of wages growth to the tight labour market, which is not quite so evident in the likes of the United States and not evident in Australia either. We've had that 8.6% increase in those private hourly earnings over the past year. I certainly don't think it'll be as high as that in the coming year, but it means something interesting for that ratio of house prices versus incomes. Now, I can cite the number that since the start of the pandemic, or just before the pandemic, average New Zealand house prices have increased by 26%. So we'll hear a number like that and we'll all say, well, that's a heck of a lot. But incomes have gone up by 14% at the same time. And each month the incomes go up and the prices are still going a bit lower. At the end of 2021, the ratio of average house prices to the average incomes, using that wages measure there, was 30% above the level pre-pandemic. Now we're only 8% above the pre-pandemic level. So when we measure affordability by prices versus incomes, we're almost back. Within probably a couple of months, we're going to be back to where we were pre-pandemic. The interest rates, obviously a heck of a lot higher, but that again is a thing that each month goes by, people will rework their numbers and go, actually I think on our wage now, we can afford a house. So that's also a slowish thing coming along there. And also associated with the strong labour market driving the good wages growth would be good job security. The Reserve Bank have predicted that the economy will shrink by 1% next year. I disagree. I think there's actually some good support for a range of factors, but let's assume they're right. And on that basis, they predict the unemployment rate rising from 3.3% to 5.7%. So 1% shrinkage driving 2.4% increase in the unemployment rate. During the GFC, our economy shrunk by 3% and the unemployment rate went up 3.1%. The numbers don't match up. How can we get, in the situation at the moment, only 1% GDP shrinkage, the economic activity in the country, have basically twice the impact on the unemployment rate as during the 08-09 recessionary period, when now the labour market in New Zealand is the tightest any of us have ever seen, and there's some data on that starting from about 1970. I don't think the unemployment rate is going to rise to the degree that the Reserve Bank are hoping for, and that'll deliver job security out there. For the investors, well, they've definitely stepped back from the market anew recently with the talk of recession and the extra increase in interest rates there. But the way the political opinion polls are going, there's an increasing chance of a change in government late in 2023. And that, of course, means if they stick with their stated policy, reinstatement of deductibility of interest expenses. And so as we get, let's say maybe winter next year, some of the investors may be daring to step forward again. Also, something else to note there, construction costs are going up and up all the time. So that's sort of a very sort of spongy level of support on average for prices out there. History shows that once house costs, the construction costs sort of stop rising, they don't tend to go back to where they were before the materials prices went up. So yeah, sorry for anybody looking to get a house built. I don't think you're going to be getting much cheapness in prices of the materials in the near future. And let me note one other thing I've just written a little bit about recently as well. The stock of properties listed for sale in New Zealand, August last year was about 15,000 or so. It was pretty much a record low. We were at 28,000 a couple of months ago. Now we are down to 26,000. And there is an established relationship between changes in the stock level and eventual changes in prices. I've done a graph on it most recently. So I put all of these things together, acknowledge the worrying outlook still for the world economy, acknowledge the building companies, some are going to fall over and that'll keep sentiment relatively muted, but I still believe we're in the end game. I still see the market broadly bottoming out now around about winter or so. Previously I was thinking maybe the March quarter of the year heading into autumn. I think it's going to take a little bit longer to come along, but I think in hindsight 2023 we will view as a year in which the decline in the housing market in New Zealand stopped. As to going up the other side, well, you tell me what's going to happen in Ukraine, what's going to happen with interest rates. These are very uncertain. Oh, and on the interest rates, I think what I need to say there is I think we're at the peak for these fixed mortgage rates. What you see in the market at the moment, I think this is fairly much as high as it gets. The banks have restored their margins on fixed rate lending to their average levels over the past 2 years. So they're not under special pressure to increase again. And especially when we look at the wholesale borrowing costs for the banks, they are basically already reflecting an expectation that the official cash rate will go close to 5.5%. And some debate you may notice out there at the moment, many people are saying, I wonder if the Reserve Bank in fact are putting too much restraint on the economy, because we've got evidence of a collapse in business spending, hiring intentions and confidence before November 23 change there in monetary policy. I can see in my spending plan survey a big pullback in consumer plans for spending as well. So there's a chance the cash rate doesn't go to the predicted 5.5%. So I'm 90% confident, as in I'm leaving a little bit of space in there, 90% confident that what you're seeing at the moment for fixed interest rates is the peak for the cycle. I would expect declines to be setting in maybe from the middle of next year. One or two banks might discount the 3 to 5 year rates just ahead of that. What about for the regions? Just some quick comments there, because there are some interesting dynamics in play. New Zealand hasn't yet had this commentary come out, but I'm seeing it in Australia now, where people who fled to the regions during the pandemic, they're now going back to the cities, employment reasons, cultural reasons, whatever it may be. I think we're going to see a similar version of that in New Zealand, not as strong. I don't believe in New Zealand as many people shifted to the regions from an employment point of view, but I've always said that I believe many people who are looking to sell out of Auckland in 2022, 23, 24 and shift to the regions accelerated their plans. Well, now they are already there. So I don't necessarily think we're going to get a big movement of people from the regions back to Auckland, Wellington, Canterbury, Christchurch. But I think people who are going to leave over this coming 3-year period, I think many of them have already done so. And so I just think that there is good scope, in fact, for outperformance, especially of Auckland in the next maybe a couple of years, especially on the back of the migration flows. When we Kiwis, people generally leave New Zealand, we leave from the country overall. But migrants go where migrants have gone. Migrants will go back into Auckland. So that in association with Auckland is actually well below trend. Their prices versus the rest of the country looking relatively cheap, if you can call it that. I see scope for Auckland outperformance. Canterbury, Christchurch there has still got some scope for a bit of a catch-up there post-earthquake. And Wellington has almost done the bulk of its correction back towards trend. It was really overvalued, but not so much now. South Island never really attracted sort of the surge in prices, pandemic to the same degree as the North Island. I think there's scope for underperformance in the North Island outside of Auckland predominantly, and Wellington maybe. Taranaki, it's a bit special off on its own. It really didn't join in the big surge in prices to any great degree, but your Bay of Plenty, Waikato, Hawke's Bay, Manawatu, Whanganui, I think there's scope for a bit of weakness relative to Auckland there. For the South Island, the likes of Nelson, Tasman, Marlborough, etc., Southland, these ones never really got themselves to overpriced levels, so that means I don't have anything interesting to say, frankly. Queenstown Lakes area, tourists coming in, there's probably going to be outperformance there again. Overall, 2023, I think, is going to be a story of the housing market eventually bottoming out. We're only going to know in hindsight. I have zero expectation that I can pick the month when prices bottom out, and for goodness sakes, don't be looking for any solid predictions of how quickly prices will rise. Just keep in mind that when you're buying a house, it's something you should be looking at over the long term, whether it's an investment or whether it's your first home, etc. And so as an economist, I guess I'm trying to help you by standing back from the market and seeing those underlying longer term trends, and not the flibbity gibbet sort of month, quarter to quarter stuff, which is always there and is going to remain there going forward. So I see the interest rates, like I say, have probably peaked, 90% confident, and some declines coming through 2023, maybe especially in the latter part of the year. But basically, look, thanks everybody who's been tuning in to the weekly Tony's Thoughts video there, and especially the tea with Tony, even though there's no tea around me at the moment. I've enjoyed doing these things, and we've got a few more scheduled for next year as well. Merry Christmas, everybody. Have yourselves a happy new year, and speak again in 2023. And again, have a look at these underlying trends in the housing market. All the best out there.